Alright guys, we are going to cover a few topics tonight on swing trading and how to capitalize on intermediate term swings in the marketplace. And we're going to go outside the realm of the standard 20-30 pip swings that you see me posting in the kill zones. These are kind of like on the heels of the last webinar we had. We talked about the impact of the futures market and the contracts that are traded in currencies for futures. The notion of tracking smart money with the tool open interest. Okay, there is a lot of information is going to be given to you about that, but this is going to kind of like give you an overview on how to, number one, track smart money, and they leave very clear telltale signs in the marketplace, and it's not like it happens after the fact. In other words, you can see these things coming, and when you do, obviously you can take advantage of it. So who is the smart money before we get involved in looking at how to look for them and their footprints? Well, smart money is anyone that has more money than all of us collectively. That means it's banking institutions, institutional trading firms, and basically the elite. Okay, and they trade on a larger scale and larger volume than all of us retail traders do. So they are essentially the market, quote unquote. The only way we're going to make money as traders and speculators in currencies is to ride the coattails of the movement that they create themselves. In other words, they are the market. They generate the oscillations up and down in the marketplace. All of our fancy indicators, momentum indicators, all these tools, they are absolutely useless without the participation of these big money players. In other words, if the market isn't predisposed to go up, your oversold indicator means absolutely nothing. Okay, if the market's not predisposed to go down, your pivot levels on the resistance 1 and resistance 2 levels means absolutely nothing. Okay, the tools that I've shared thus far are basically little concepts to hopefully ferret out when the smart money is participating in the market. Obviously, they're participating all the time, but when do we see a massive shift in sentiment? When are they moving flows up? When are they moving flows down? And when are they not moving the market at all? When it's going to be in consolidation? Because there is a cycle in the market where we move from consolidation to trending or breakout. Okay, and I don't want to use the word breakout because I'm not a breakout trader, but we're going to go over that at length here. But there's cycles that constantly repeat themselves in the marketplace. The relationship of, on a daily chart, small range days expansion to a large range day. Okay, we've learned that typically on large range days, the open is on the opposite extreme of the close. Okay, so as a short-term trader, we want to try to get in early, near the opening. Okay, and for me, I watch the New York midnight time frame, and typically what you'll find is on a large range day, within the first 4 hours of trading, that means midnight time New York Standard Time to approximately 4 a.m. Now sometimes you'll get a deviation and it'll go as far as 5 a.m., but typically that's about the cusp of the boundary of where the high or low will form for that particular trading day. Usually when we have daylight savings time impacting the market, then you'll see a small variance in terms of the 4-hour window between midnight and 4 a.m. or to 5 a.m. as a maximum. Okay, so I don't really consider daylight savings time when I do my kill zones. I just look for a buffer of 1 hour before and 1 hour after my local time. So in other words, if 3 a.m. is London Open, by my definition, I will start looking for a London Open trade as early as 2 a.m. my time. Okay, and that would translate to 700 GMT time. Okay, so that would start your London time frame for London Open kill zone. Well, what we've said so far is basically, as a trader, If we can focus on the times in the marketplace where we can see a market in consolidation, okay, or range-bound trading, usually what will happen is most traders will beat their brains against the wall and they'll try to bracket the market with a buy order or a sell order above or below a consolidation range, in hopes that hopefully that the market will break out and continue in that direction. Well, my point in sharing this information is you don't have to do that. Okay, there is insight in the marketplace and in charts without wading through fundamental data and all that. There is a means of determining what the smart money is about to do in the marketplace. Okay, now, and I apologize if you guys can hear me drinking, but I gotta keep the whistle wet rather. So we're going to use this this area right up in here. Okay, we're going to look at the market had moved from a consolidation in here. Okay, now we can look at why this broke out and moved up in a moment, but for now we're going to use this consolidation in here. Okay, so the market had moved into another consolidation. Okay, so we went from range, okay, consolidation, trend, consolidation, trend, consolidation, trend, consolidation, trend. Now we're consolidating again. Okay, in these times when the market is in consolidation, okay, typically this is where new traders and those that do not know really what they're doing, okay, will beat their brains against the wall, okay, and they will absolutely churn their account, overtrade, do too many trades, and chase the market. Okay, you can trade within this range and make money as a scalper. You can make money as guys, can you still hear me? Yeah, I was saying the transmission was being paused. What was the last thing you heard me say? Okay, thank you. If it pauses again, I'm going to have to go back to a smaller chart. If I stay with this aspect ratio, it's just going to be a problem if I stay with this, because I think when I cover that website, it's not allowing me to transmit. If I keep it to this size, is this okay for you guys? All right, when I need to, I'll go in tighter on the chart, but for right now, I'm going to bring it down to this. Okay, we'll keep it in this this dimension. Okay, so here's that trading range we were working within. Okay, and this right now we're looking at a 5-minute chart. Okay, now I'm using a 5-minute chart simply because I'm going to highlight Friday's trade, and then we're going to go into some of the concepts that led up to that trade. Okay, so we're going to go from the small frame to the higher time frame. So it's kind of like a top-down analysis in reverse. So it's going to arrive at the same thing because we're looking at a hindsight move. So again, so we are in this area here. Market had moved into a consolidation, and traders will typically try to sell what they believe is the high in here. Okay, and what will happen is the smart money will continuously, okay, accumulate positions before the actual move transpires. Okay, we have a consolidation here, market runs up, and then it builds a fractal in here. Okay, this is where all of the pairing of orders, okay, and the accumulation and or distribution of the next market move takes place. Now, in here, there's all kinds of clues that the smart money leaves, okay? And we're going to cover those tonight. So we're going to know before it does this and breaks out here. Typically what you'll see is traders will take their little horizontal lines and they'll say, okay, here is the trading range that we're trading in right now. Okay, and what will happen is they naturally assume, okay, well, we've made a low here, and we've traded up, we've consolidated. Look, we've made a bull flag, guys. Look at this. Okay, this is a bull flag. Everybody get on board. It's going to go higher. So, because new traders and street money are very paranoid, they're like deer in the headlights. They really don't know what they're doing, but they want to get in. They don't know what they want to do, buy or sell. So they just look at the chart, and whatever it's done in the last 5 minutes, well, naturally, if it's gone up, hell, I'm going to go and buy it too. So they'll look at this market here and say, okay, well, we've moved up, we've broke through resistance, okay. So let's look at this. They bracket their support and resistance levels. They put a buy here, okay, and then they'll put a sell, a stop down here, saying, okay, well, if it goes up here, even if it pulls back into the range a little bit, it'll still probably go in my direction and go higher. And I'll be protected because my stop will be below here. Okay? Well, I'm going to tell you, that game is absolutely the worst thing you can do. The worst thing you can do. And the pattern that I trade a lot, which is Turtle Soup, really capitalizes on the notion that the market has people placing buy orders. For instance, right here. Okay, they would have... Let's draw a line on this real quick so you can get an idea what I'm referring to. Okay, this level here would have been violated right here from this high here. So in other words, this is a Turtle Soup sell pattern. Okay, so you could have made money going down. Anybody that had an order buying on a breakout, what they would have thought was a breakout here, okay, because this could have been very easily viewed as a bull flag on a higher time frame. Okay, looking at that pattern, okay, and could naturally, it's a continuation pattern. Traders that are weak-handed, okay, or easily shaken, they want to have confirmation. They want to see, is the market really moving in the direction I want to be trading in? Okay, but the problem with that is, once the moves already start, the odds have precipitously fallen off in your favor of it being a profitable trade. Not to mention, if you do place your buy order above the previous high in here, and they want to be buying what they think is strength, but you got to take into consideration the market's already traded 66 pips. So naturally, you're going to see at least a very minimum likelihood of 15 to 20 pips retracement if you're going to trade an old high. So that's why I tell you guys to use a concept of using previous day's highs and lows and look for a move of 20 pips, because the market makers are always going to try to pair orders above previous highs and previous lows. Okay, so if we see price trade above an old high in here, okay, naturally, once you see the initial break, unless it's news event driven, what you'll see is it'll pierce it just by a few pips and then trade back into the range that was prior to it. So this is the range here. This is the low. This is the high. So it'll break that range here and then trade back into it and consolidate and then shoot one more time if it's going to try to drive more people out. Now, what do you think's happening? Right here you have an old high. You have buy stops on street money, stupid, neophyte traders like myself. When I first started, I did the same stuff, guys. I can talk from experience, so I'm not trying to be offensive to anyone that's doing this or has done it and fell victim to it. I traded like this, okay, and I never made money doing it. So, well, that's not true. That's not true. I did make money in wheat in 1995, and again, that was a fluke. I made a lot of money on a mistake, and it could have very easily wiped me out. But that example aside, I've never made money breaking out. So, going back to our example, if you're looking to be a buyer on strength and you're trying to buy a breakout, okay, what will happen is it'll trade back down in here. Okay, so here the buy stops are triggered. All right. So they're going to pull it back. Well, naturally, they're going to look at this level here, they're going to look at this level here, and obviously down here. Where do you think, without answering guys, where do you think the majority of the stops are going to be resting at? Here, here, or under here? Well, clearly, this is the more intermediate term low. Okay, so if this is going to be an accumulation point, okay, or a distribution point, they're going to reach for wherever the most stops are. Okay, it's because they need the liquidity to get themselves in the market. Okay, banks are not trading 10,000 leverage. I mean, they're trading millions, billions. I mean, they're in huge blocks of this stuff. So they're not worried about your little micro account. They're not worried about my mini account. They're not worried about Joe Schmo's standard lot account. But they do look for pools or pockets of resting stops because they need that liquidity to get their orders filled. Okay, and so what they'll do is the market will gyrate, and market makers will pair these orders to old highs and lows. Okay, to establish a means of liquidity, allowing the market makers on a larger scale to get in and position themselves. So what will happen is you have your breakout here. It'll fill, pull back down in here. Okay, so naturally what will happen is the weak bulls will get scared out of the market. Okay, they'll see that even if their stop's down here, or if they place their stop right here, the market will trade right here, and all of a sudden they'll say, "Oh no, it's going to hit my stop. So what am I going to do? I'm just going to sell out of it right now. I'm just going to get out of it." Okay, and what will happen is that'll feed the fire, because now anybody that did trade the breakout, okay, on a false break, they're going to have a buy stop here on their short. So now you have a pocket of buy stops resting here, which the short covering, the stops on this move down here for anybody that broke out buying here, then tossing it out and saying, okay, look, I want to be out of the market. That pairing up the orders that are resting above here will allow the market makers to pair up all these buy stops that are resting above this point. Okay, so in other words, if you have this high here, there's going to be buy stops resting above that. For players that would have had a stop higher than this here, they would have been looking for a much more significant move up to get them long on the fiber, which is the Euro USD. Those individuals that went short here earlier, okay, may have had a resting stop a little bit more higher than the tripped here. Okay, so you have a higher pocket of stops to consider. So people that are short here or looking to go long have buy stops. Two types of traders there, but a large pool or pocket of stops. I don't need to see data, okay, coming across market makers' desks and order flow and all that stuff. I can see the chart, and I can determine where stops are going to be at based on how price is trading. And this is what my premise is behind teaching these concepts without indicators, is because if you learn to develop this skill, you can clearly look at a chart within 20, 30 seconds, any time frame. You can clearly discern where stops are, okay, and you can anticipate the market moving to that level, because that's where the highest liquidity is for them to pair up another block of orders. Okay, so the market would trade up, blow above this high here, blow above this high here, fill up all the buy stops. Okay, now if they're going to trigger, if they're going to allow the price to get up to this point here to trip the buy stops, okay, think about it. They don't really want you getting your fill to go long and then see it make money. That's not in their interest. They don't want that. Okay, they want to get the other side of that trade, so they naturally will allow price to go up. Okay, it'll fill here. Everybody on the street, retail traders and all that, they'll say, okay, well, it broke out. It's going to go higher because here we have another bull flag. Price will trade up. Buy stops are filled. On the other side of a buy, there is a seller. Okay. On the other side of buys is a seller. Who do you think, in consolidations like this, who do you think is interested in taking the opposite side of that trade? The banks, the institutional traders, the Michael Huddlestons, the people following this thread. That's what I'm trying to get you guys to learn. Look for these types of events to take place, because these are big footprints in the sand, because this will absolutely tell you what should unfold in the marketplace. Now, if you are new to price action trading, okay, you want to see the event unfold and then slam back down into the range. That's what you're looking for, okay? This is one of the biggest tips that you're going to get as a price action trader. Do not go in trying to get the very high. Do not go in trying to get the absolute low, okay? Granted, you can get lucky once in a while. I have been lucky in the past, and I've been able to, to nail down some pretty good trades. But my absolute longest term consistency is found with letting the price show me, okay, which is right here. I'm anticipating a false breakout, okay. Right in here, I'm going to expect to see price to reject. Once this drops down, okay, that's already told me now there is a huge block that was established right in here. Now, someone on a larger scale than myself has now established a net short position. Okay, price will drop down. Now, they're going to have to get the suckers to get back in there again to try to get a better fill, because if they want to get short, they're not going to get it all. They're not going to get all their position in here. Okay, there's going to have to be another portion. In other words, they don't take $200 million. Okay, is not that much in terms of a bank. Okay, but we're talking billions of dollars. You can't get that much in this high here. Okay, so if they try to put all their order in at one time, they're not going to get it all off. Okay, depending upon if it's a larger. And I don't want to throw numbers out because it's hard for new traders to grasp the types of flows that these institutions can put in. But the bottom line is they allow the market to trade down. Okay, and then it'll trade right back up again. But here's where the optimal trade entry takes place. Okay, the psychology behind the market pattern that I've taught is, number one, you want to see price tip its hand to you. Okay, we have a false breakout. Price trades back down into the consolidation. Okay, we're basically seeing distribution unfolding in the marketplace. Okay. Now, price action traders can very easily see this. Obviously, in hindsight, I grant that. But this right here is a head and shoulders pattern. Okay? But I guarantee you, for those individuals that see price start to drop down here, okay, and then what will happen is they'll say, okay, I'm going to put my stop low here. Price trades right down to that point here, blows out the stops, okay, and they run it right back up to try to sucker one more time those individuals that would expect a breakout above here. Okay? Well, this is where the failure swing takes place. Okay? So if we take our fib and you pull the high down to the low, look at all, let me zoom in, guys, I'm sorry. Look at the amount of time that we spent within the 62% and the 79% retracement level, that sweet spot I teach you for optimal trade entry. This is where all of the pairing of orders is taking place. Okay, they're basically taking all of the individuals that want to get long on this market, they're filling it, and they're filling that other side of their trade, which is net short. Okay, and then all of a sudden you see the market slip and fall off. Okay. Now, once we get back deeper into the consolidation, which is this high here, this low here, we can start pulling our fibs on key reaction points. Okay, a reaction high and reaction low, which is nothing more than swing highs and swing lows on whatever time frame you're using for your trading. Okay, so we have a optimal trade entry in here. You would look to get short, where it nicely converges with a resistance level, okay, which is also, for those that are following the thread and the levels that I teach, institutional levels that the banks like watching is the 20s level, 50s, full figures, and 80s. Okay, so basically if you drop your line on 20, they worked the institutional level 20 right in here, a nice round number. Okay, granted it did tip up to around 45.30 in here, but there you go, it slipped off. I essentially was able to nail in a trade for 21. So I got 45.21 on here on net short. And price slid down in here. And I was trying to establish another portion here because I expected some breakdown. And we're going to get into more detail as to how we knew it was going to break down in a moment. But price didn't get up into the sweet spot for this optimal trade entry. It only gave me to 62% retracement level, which is what I disclosed before in earlier presentations about using the optimal trade entry. If you use the 62% retracement level all the time, factoring the spread, you'll get nailed all the time with getting into trades. But because I do want to try to narrow the amount of risk down, because my positions are a little bit larger than most going in, I don't want to risk a lot of money. So I try to get right in the middle of the 62 and 79% retracement level, which is the sweet spot for optimal trade entry. And generally, that's where you'll see it go and then tank. But it didn't get there. So missed opportunity here, but I did get the 45.21 short here. Now, what do you think's going on in the minds of all the traders that were now long here, but were stubborn and said, I'm going to keep my stop loss below this low here, because this is the most significant low. It's going to consolidate and it's going to eventually break up to the upside. Well, what's happening, okay, this is pain. Okay, and I'm sure you've been in a situation where you're watching the market trade, okay, and it looks like this on your chart. Okay, you see this. Your stomach's in a knot. If you're drinking coffee, I don't drink coffee, but if you're drinking coffee, it's going halfway down and stopping because you're thinking, oh no, look at this. I rode this thing all the way down, okay, and then what'll happen is you'll see this. All of a sudden, you breathe that deep sigh. Man, I got through it. Okay, it was just a fake out. It was almost getting down there, but let me look at my indicators here, and you pull up stochastics or RSI or whatever the indicator you like, flavor of the month. Okay, and you may be seeing some bullish divergence in here. Okay, and all of a sudden you feel rest assured that your trade's now safe. It's going to now move on up. Well, right in here, what do you think unfolded right there? What level is this? That's a full figure. That's the 45. Okay? See this high in here? Without even drawing it, those that have been using the concepts that I've taught so far, the optimal trade entry is going to be right in here. Right on the figure. So that's why I'm going to pull this swing high here down to the most significant reaction low. Here's optimal trade entry right in here. You want to get short. So now, if we've established where the market has been distributed, okay, we can now look to pair our trading with the momentum and the direction and the premise that the larger traders are doing. Okay, they're distributing all in here. They're selling. So when price trades up, they're fading all that, and they're selling in all this. And then all of a sudden they'll stop pairing the orders because they really don't want price to break up. They want everything to stay within this nice little neat consolidation area. Okay, and all of a sudden price will trade back down, right down to the old low here. Through it, back up to it as support now turns resistance. What do you think this is right here? Well, if you pull our fib down to the reaction low prior to it, and on the reaction high prior to it, optimal trade entry if you want to get short, right in here, right on the central pivot, which is this little, I guess it's pink. Is that pink, guys? I think it's probably pink. It would be pink to you. It's almost looking pink to me, but put it that way. This right here was optimal trade entry to get short. And this was actually, if you look at the time frame, this is New York open. You have New York open right in here. All right. Now, if we go back to New York midnight time, okay, here's New York. The high was made within the first 4 hours. Here's the high of the day. Okay, we traded down. And what I teach is, once you determine what the high or low is for the day, based on New York session, the London session rather, the London session typically will put in post the daily high or low for the market. Okay, the only way you're going to get hurt, okay, is when you have consolidation days, range choppy days, and they're typically right before news events that are going to unfold the night later on the following day, or later on in that trading day. So if it's going to be a news event or a market moving report, or numbers are due out, like non-farm payroll, whatever, you just basically want to trade, a lot less risk. You don't put that much leverage on your trades. But the London Open doesn't have as much impact on like a non-farm payroll. It can aid you, but I use basically a pivot, a key support level, and optimal trade entry in key report times, because anything can happen. Those reports are notorious for rating people, and that's the type of trade where if I do get knocked out and it's a fake out, they blow me out of the water and run my stop, I'll immediately get right back in, because I know the mindset behind what they're doing. They want to clear out everything, take the other side of the trade, and then it runs where it's intended to go. Okay. But anyway, here, this is the New York open window optimal trade entry. We are trading in the direction of what has already been established for the day. The market had made a high. We've traded down. Okay, we went below the central pivot, traded up to it as resistance. Okay, after blowing out an old important low in here, so now we've broken this trading range. Okay, we've broken it. This right here is what typically is taught in all the classic books. Okay, and the book that I mentioned in the thread earlier today, Technical Analysis of the Financial Markets by John Murphy. This was one of the first times I saw that understanding of how support and resistance works if you do identify what the actual trend is about to do early stages, before you see this nice obvious one-way flows in here. Once you break out, you trade up to the resistance as old support now becomes resistance. Look for your entry pattern. One of our generic entry patterns is the optimal trade entry, running the fib from reaction highs to lows. Wait for it to trade up to at least the very minimum 62% retracement level. When it starts to sell off in your direction, you want to take first profit at the old low here. Okay, and let's take a look at what that would have paid you. Okay, first profit's around 20 plus pips. Okay, it's not bad. To me, that's about a standard scalp. 15, 20 pips, that's a good scalp. Less than 15, I'm not looking for it. Okay, so very minimum, I'm looking for 15, 20 Alright guys, can you hear me? Sorry about that. For those that I have been in live events, I have 5 children, and 2 of the least in age in terms of being under age of 5. They clamor sometimes to get into the area where I'm recording or doing presentations. So if they can get the door open enough to know that I'm in there, or if they listen to me talking, they naturally think they need to be in here with me, so they'll fight and try to get in, and then they start arguing amongst themselves to who's going to be the first one in here. So yeah. All right. So anyway, looking at the where were we at? The chart for the fiber. Okay, we were talking about how we could identify how the market makers are pairing orders and allowing smart money to establish their net short position before the absolute drop off occurs. Okay, so now we've hopefully identified how we can use time of day, we can use the optimal trade entry and kill zones and round numbers, institutional levels, how they impact the market. Okay, and for the most part, generally you guys probably aren't surprised by what we've covered so far. Okay, we were in a Asian range time frame. I was in Baby Pip's chat room, and forgive me if I don't remember anyone else in the chat room at the time, but I know I was talking when Wade was in the room, and that's hello goodbye for those that may not know him. But we were talking about what was possibly setting up for the market moves for London. Okay, the London session. And what I basically suggested was we would see, because we're in a consolidation in here, okay, what will happen is the market will see this clean. See how clean this is? This is a very clean level. That, to me, when I see that, that's very suspect. I know, because of experience being in the marketplace and seeing these types of things, I know there's resting buy stops above here. Okay, there are people that are looking to go long. Okay, and there's also individuals that have resting buy stops on positions that are protecting what they've made in terms of profits going lower. Okay, so what I was anticipating is that market makers would run the market up, pair orders above these levels in here, okay, create an order, false breakout, and then the pain would come. That was the comment I posted in the chat room. So basically what we're doing is we're anticipating a false breakout to the upside, look for a high to form, and then they slam it down below this level in here. Well, market trades right up above this level here, guns out all the stops. Where does it trade to? Institutional level 144 figure. Okay. Immediately, price slams down below the lows here. Okay, right in here. Trades down much, very, very steep sell-off. I call this riding the lightning. Very fast one-way flows. And this was the event that unfolded. So we have another area where we consolidate. Okay, market tips everybody off thinking it's going to go higher. That chase price, in other words, if you're looking at just this, okay, if you're just looking at that, that could be very exciting if you're a new trader. If you've had really no experience with how market makers and smart money participate in moves in the marketplace, this could be viewed as, okay, well, we traded above this level here. Okay, this is a new level traded to. Well, now we should be trading back to that. This is resistance here. It's going to become support. That's what the books teach us, right, guys? Well, not all the time, because you have to have the understanding of what are the institutions trying to do. Okay, they want to take it up here for a reason, because everybody's been in this mud. Okay, and what was the move prior to this move? Prior to this consolidation, where was price coming from? Coming from this level up here. Okay, so they're going to drive it another leg lower. Boom. Okay, they're going to take it in. Well, here's the time that you would have, if you're street money and you're trying to buy what you think now is to support. Okay, you're going to try to go long here, and you'll probably put a stop loss rated below here. That's what the books teach us. Well, as you can see, Price didn't spend very much time here at all. Went extremely hard through these lows here because this is where liquidity was resting. They drove it down, put in the low, and then we consolidated again. Okay, moved into another consolidation. Now, price trades below this low in here. Okay, we've got a consolidation, a lot of stops resting below here. Market finds liquidity here. The stops are resting above here. Now remember, that was the consolidation. False break below here gets everybody thinking it's going to break down lower. All of a sudden, extrapolated move to the upside on the heels of a major market moving event, which is GDP. And then all of a sudden, you'll see these one-way flows take off, and the market drives higher, guns out the stops here, and it just keeps reaching higher and higher. Where's it going to reach for? This high here. And you can see clearly took that out here. And we've consolidated again. Okay, so where do you think price will go from these levels in here? Where do you think price is going to try to move to next? You can answer this one. I know I've refrained from asking questions for direct answers, but you can. I'm not necessarily looking for a price. Just give me a direction. Where do you think it's trying to go to? Okay. I didn't see anyone say no, and that's kind of cool because that's the general idea I'm thinking too. So we went through the market out trades from consolidation to range expansion or trending, then goes back into consolidation, okay, then expansion or trending, okay. So we have that cycle understood very clearly. Let's look at the cable and review how Friday's trade unfolded for me. Alright. These levels, or these little arrows above and below, key highs, short-term swing highs and lows here, nothing more than a simple little tool that's readily available on MT4 platforms. It's dubbed as fractals, as you see here. I'm going to take them off for the moment because that's not what I want to show you. This right here is GMT start time. Alright, now what I'm going to do is I'm going to give you the New York midnight time frame, which is where I like to follow price action. And then I'm going to also drop in the beginning window of the London Open, which is typically 700 GMT time for me, and .900 GMT. So between 700 and 900 GMT, like the thread suggests, there's typically a swing that unfolds between those two times. In other words, basically it's a 2-hour window. Now it could happen as early as 1 hour before, and you'll get the Frankfurt opening, or 1 hour later, okay, and you'll get the Asian close. So you kind of like got a buffer, but I've learned to trust that 700 GMT and 900 GMT typically will give you a London Open trade, because at 800 GMT is typically 3 a.m. Start time for London traders. Now, like I said, I'm not going to get into the deviations that daylight savings time sometimes creates. I just ignore it. Okay, I know a lot of you guys try to figure out well, it's daylight savings time, and then you got to shift this and shift that. I'm not shifting anything. Okay, these numbers static. In my mind, I'm looking for 700 GMT, 900 GMT year round. and I'm looking for the swing low or high to form in here to trade based on the direction of the day. Okay, so we have market trading down, makes a low, okay, right in the time frame when well, let's look at this candle right here. All right, that's 20 minutes after 3 o'clock in the morning. Basically, it's 8:20 GMT. So market moves up, trades back down, and it's finding support here at this level, 162.62. Now this is just a 5-minute chart, so this right here absolutely shows you nothing. All right. Unfortunately, most traders get into Forex because they have friends, family, or whatever, and or they talk to somebody on a chat room and they've seen some guy that has a website or a thread, and he's posting videos and he seems like a genius and he's referring to 5-minute charts, and naturally they assume that I just look at 5-minute charts because I'm referring to one in these reviews. But there's a lot more to the analysis. I'm just showing you very close how I'm narrowing down the risk, but the higher time frames is where the action's at. You really need to be watching those, and most of the time of your analysis should be spent on the higher time frames, the weekly, daily, 4-hour, 1 hour, and then looking for setups on 15-minute and narrowing down the risk with the 5-minute for entry. Well, I have these levels here, and it's the 162.80, which is institutional level we like to watch, and the 162.62 level. Okay, we're going to highlight this little area right in here, and that'll allow me to zoom out to a 1-hour chart. Okay, there's that same level. Okay, let me take off the period separator. Okay, now right in here we've noted this area of potential support. What made it support? Well, if you look at a 1-hour chart, we have a key level right here, and it just happens to be the 162.62 level, 162.63 level in here, and again in here. So just pure support resistance plays, this should be an area where you would be looking for a reaction. Okay, if you just looked at a 1-hour chart, okay, just a 1-hour chart, guys, and never looked at any other chart, you can have outstanding setups unfold in your trading if you follow where key turning points have taken place in the 1-hour chart. For instance, this level here, when we traded back down to it on Friday, okay, reaction very significant. All right, this high in here, okay, well, it found support here. Price, when it moved out, found support, traded on up. Okay, well, Friday we blew out these highs here, but then immediately pulled back. Think about what we're doing right now. Okay, we're working a larger consolidation. In other words, there's something going on in here, and I'm not going to say right away yet, but we're going to mention it before we close this presentation. But in this big, huge consolidation, there is a large entity doing something in the marketplace. Okay, and we're going to get to what that is. But how did I know that the market was going to run up in the cable here? All right, well, we already identified this level here. Can you see the chart, James? Okay, you got it? Can everyone see it? Okay. Okay. Well, we've identified a 1 hour chart time frame. It's okay. It's pointless if I'm talking and you don't see it. It just makes a lot of questions longer after the session, so it's important. If you don't see it, that's what I need to know. Well, we have a key support resistance level, obviously, in here. Price had traded back down to it. Higher time frame, 1 hour. It's very key for significant magnitude setups or swings, and reaction levels on a 1 hour chart are very rewarding because you'll get nice moves. Even if your longer term analysis is wrong, there is still means of profitability in terms of a bounce, and that's what I want to get your mindset to, because you don't necessarily have to see your 150 pip trade unfold to the pip, to the pip. If you're able to get 20 pips out of it or 30 pips out of it and it reverses ultimately on you, that should not make you feel like you're a loser. It should not make you feel like you're a bad trader, because ultimately it's not about whether we're right or wrong. It's about whether or not we're making our bottom line larger. And hopefully you're doing this to build wealth, and it's not gambling, it's not a game, because if there's any other reason for you to do this outside of making money, you got the wrong mindset. I'm sorry, play poker if you like that kind of thing, but this is really intended just to make money, and that should be your number one mindset going into it. So we've identified a key reaction level to anticipate at least at very minimum a bounce. Okay, so let's go back down to a 15-minute chart, and we're going to look at, and we're going to take this rectangle off because we've already delineated the area and made reference to it, so now we don't need this now. Okay, price trades down into a low here. Now we're going to take this level, this vertical line, and we're going to move it over to 1200 GMT. Alright, that's the beginning window for New York Open. Okay, and we'll use 1400. Alright, see this candle right in here? Very huge candle. Alright, that candle is your news candle. Alright, one of the biggest questions I get is, ICT, do you trade the news? I trade the chart. If there's news coming out, my concepts, for the most part, generally tip me off to what the news is going to present. The only caveat to that is non-farm payroll. Non-farm payroll can be crazy. It can be absolutely nuts. Okay, and even though my trade analysis will tell me the direction is right, after if I look in hindsight, it's like, yeah, I anticipated the trade up to this point here, and then whatever happens is fine. But what will happen is, generally, if I get in the market, and like I said, I don't trade non-farm payroll, but I made a point to do it this month, just to prove that I could do it. And I went long the euro, and it went down, tagged me, and I immediately got right back in, and I was off by 5 or 6 pips from my original entry, and then coming out, and mitigating the loss. But then I ended up getting net short later on in the day, and then made money. But anyway, this time window, or kill zone, I like to refer to as New York Open. All right, so we made the low on the day, all right, at a key support line or reaction level on the higher time frame 1 hour chart. Okay, right in here. Now let's go and drill down to a 5-minute chart, because we're going to show how we can really zero in on a low risk swing trade and take advantage of range expansion that we would anticipate. And I'm going to show you all that, how we got to that too, but for now we're just going to go over the entry. We made the low in London. Okay, price trades up, which is what we want to see. You want to see a swing. Now, the more pips you have on the initial swing gives you an indication on how much potential profit you have. Okay, so the low made in London to the high going into New York Open is roughly 44 pips. All right, that's a pretty handsome swing to anticipate a trade in. Well, we are at a level on a higher time frame 1 hour chart to at least a very minimum expect a bounce. All right. Well, price is running up. Who do you think is buying it ahead of the news in here? I mean, we have price moving up, going into a key market moving event, GDP. I mean, obviously, the concepts that I'm sharing is the belief that there is someone out there that has more insight, more information, and they get it more timely than us. They're greedy just like we are, or they want, at the very minimum, they want to reduce risk or exposure, so they're going to be taking part in market moves really early. Okay, so there's accumulation going on in here. All right, markets trading in a consolidation. All right, moves up, then trades down into the news release. All right, this candle right here is your news release candle at 8:30. Can you hear me? Audio check. Got it? Okay. Okay. Now, if we pull a fib from the low to that high, okay, here is our 62% retracement level. Here's the 79% retracement level. Okay. Whenever there's news events coming out, and if it's a significant impact event, I will look for the 62% retracement level simply because I need to know I'm going to get in on the move. I don't want to miss it. All right. If it's not going to be a news report coming out and I'm trading a specific session, whether it be London Open or New York Open or London Close, typically you don't see that many reports coming out on London Close. But if I'm trading New York and there's no data coming out that's going to be earth-shattering, I'll use the sweet spot or as low as the 79% retracement level to get long. But because it's a high-impact report coming out, I will look for the 62% retracement level, and I will factor in the spread. All right, and for the cable, my spread is typically anywhere between 3 and 4 pips. All right, so I'm not sure if you guys get less than that or even worry about it. I don't consider that a bad spread because I'm trading in the direction that's counter to the anticipated move that I'm trading. So I'm trading into a down candle trying to go long. That's optimal trade entry because you will quickly recover the spread that you pay going in, and you will know right away. The speed of which how fast you turn over the spread and recoup that is an indication that you got a good fill. All right. If you go back over your losses, the times where you get into your trades and time it takes for you to recoup that spread, that's typically you'll find on your losing trades, the longer it takes for that to happen, that should have been an indication that you really didn't have a good entry or a good trade, and you'll learn to gauge that by trading, and it only comes by experience. So getting long, okay, at 162.80, okay, because if we're looking at this level here, okay, let's put it right on the 62% retracement level right here. Okay, it's at 162.77. Okay, so if I add 3 pips to that, I arrive at 162.80, which is an institutional level that we like to watch for anyway. Okay, so getting along there. Obviously, very little drawdown. It was immediately snapped into profit. And now, because we are trading a expected range expansion day, in other words, we're expecting the price to run really expand on the daily chart, really get big, okay? If we go back to a 15-minute chart, since we've already nailed down our entry, all right, how do we determine our targets getting out? Well, as a swing trader, you want to look for your key reaction highs prior to the swing that you're trading. And if that went over your head, just give me a moment. I'm going to go over that right here. Here's the low we're trading off of. This is the entry pattern, the optimal trade entry. In the kill zone, right before news, I want a key support resistance level on a higher time frame, 1 hour chart. Okay, and we're gonna look at something also later on in a moment. Really determine this was a really good buying opportunity anyway, without all the things we've already covered. But just price action alone in here got us long at 162.80. All right, this is a nice little high in here. This is a nice little high in here. But can you clearly see, before we even had that move, okay, can you see that this was the leg down in price? I'm not asking for answers. I'm just saying this is what you need to. You have to train your eye to see price swings. And this was the significant price swing down, or leg down. If we're looking for a price move up, we're going to look for price to try to at least retrace within this move here. We're looking for price to break through the 62% retracement level on this downswing, because otherwise this would be an optimal trade entry to go short and then retest this low here. So we're really looking for strength while we're in a trade. This is all part of trade management. You want to see the trade that you're trading within, this swing rather, that you're trading against. You want to see movement go through the 62% retracement level, and that would have been in this area here. It clearly went through that like a hot knife through butter. But this high is what this is, as a swing trader, you're looking for this high here. All right. The reason why is because every swing up is anchored to a swing low. Every swing down is anchored to a swing high. You'll learn that the swing high on a downswing here, like see this move here down. This is the swing high it's anchored to. This right here will be a pivot point, okay, or a 50% realm. Okay, in other words, as price trades up here, you'll either see a 100% failure to go above here. It may flirt above it just a little bit and then trade back down and retest this low here. And that's fine, because if you went long here, you're looking to get profit here anyway. Right here, you want to try to take a lot of the trade off. To me, 70% should come off right here. So if you went long here, you take first profit at 20 or 30 pips. If you don't take 30 pips profit, at least portion of your trade off, you're absolutely leaving yourself open for the trade to turn against you and turn into a loser. And I'm not sure how many times you've had that happen to you, but when I was learning how to trade, there's been so many times I had stellar entries, and it really, really moved in my favor, but I wasn't astute enough to take some of the profit off, okay, and fund my trade and fund the position I'm in before I even adjusted the stop to break even, because you really want to take trade profits as they come. If you don't get that mindset developed as a trader, you're really going to have a hard time being consistent, because you're not going to always be right. You're not going to have the moves nailed down perfectly. You will experience strings of losses, and they're going to come, and I don't care how good you are, they're going to come. I had a stretch of several months in a row with no losses, and then I had a series of 7, 8, 9, 10, 11, and 2 months ago, I think it was, on my shorter term trades, I had 15 losses in a row. You guys don't see that. I'm not on here all the time saying, look, this is what I'm doing. But on my other smaller accounts, I'm highly speculative, because I'll trade a lot more frequent moves in the direction of the trend of the day. And that's not necessarily how you should trade, but because I like doing it, and it's hard for me to sleep sometimes, and I get bored sitting here, I just go into the market and I'll do things, and I'm not risking very much money. But if you are risking a good percentage of your account, and you run into a string of losses, and you don't cut back on your losses as you experience them, you can have catastrophic drawdown on your account. And we're talking 20, 30, 40, 60% drawdown on an account. And it's hard to come back from that psychologically if you're not used to trading. I guess the only thing that came out of me being a cowboy early on in my trading and trading commodities and futures and all that is I was reckless, you know, and I took on wild leverage, and I saw equity dips of crazy magnitude, and that really desensitized me as a trader. So when I see losses and the equity, drop down a little bit, I'm not really, it doesn't bother me. So when I really manage it and it's only at 1.5% or a maximum of 2% on my really loaded deal trades on the higher time frame where I'm trading with commercials in the trend, in the seasonals, and everything else is in place, I'll trade as much as 3% risk because I know I have a lot of things going for me, and I'm not trading that many times. I'm not doing that many trades a year. Usually, 3 or 4 times a year, I'm putting those types of trades on. So for me to risk 3% on a trade that I'm going to trade maybe a handful of times, even if I lost on all of them, I'm not going to experience a huge drawdown. So that goes along with risk management. What are you trading? You don't want to be day trading and scalping 3%, 5% of your account every time, because if you get a couple losses in one day, you've toasted your account as far as I'm concerned. But getting back to the trade example at hand, we're looking at the low made in London and the price looking to go higher based on what we've covered so far. Market immediately reacts positive for our trade. All right, you want to take first profit at 20 or 30 pips in the trade. Okay, right in here, first profit. At this point, okay, you want to take your trade and immediately go to break even. So your stop would be resting at what would be considered break even for you. Where at this point are you going to hold? Well, there's several things you want to look at as a swing trader. Time of day. We're trading the New York Open. There's a huge amount of battery left in this day because we haven't gotten to London close yet. All right. Let's now identify what is London close. $1600 GMT is typically about the time when London traders will close up shop. And what I'm going to do is I'm going to take all these other lines off now because we've already established the kill zone for the New York Open that we've traded into right here. And I'm leaving midnight open. I'm sorry, midnight New York time here. Here is London close. Hopefully you guys can see the lion's portion of the move was contained within midnight and London close. Okay? That right there, guys, that one thing right there I just gave you, if you do nothing else with this thread, if you do nothing else with my information, I'm telling you, if you can control risk and minimize your exposure in your trades and trade like this, wait for a low or high to form on a higher time frame, look to buy a support level after London's made a low and look to go long and hold on to that long, getting out at London close, okay, you will absolutely kick the crap out of the neophytes and the retail traders that come across these threads and these forums, and everybody comes on here. They're geniuses. They discovered a moving average crossover or stochastics. Hey, look, I'm looking at MACD. If I tweak it from 12 to a 9 and an 8 to a 6, look what it does. It gives me a buy signal sooner. All that stuff is nothing. It means absolutely nothing. This right here is exactly what you need to be anticipating in the marketplace. It repeats itself all the time. All the time. For those that have been following this thread and understand the kill zones that I've taught and the time of day and how price reacts, I've went out on a limb, okay, and I've put not only my credibility at stake. I'm telling you, I'm going to take a very small account, and I'm going to do the very things that I'm showing you right here. I'm going to do the very things that I've shown on this thread, and what I'm going to continue to show until September when there's no more teaching. It's just going to be a speculation, and you just watch it unfold. My goal is to take $5,000, and within a time window of hopefully 36 months, I'm going to try to aim for that to be a $1 million trading account. You're going to see it unfold step by step by step. You're going to see me take the losses. You're going to see me take the wins. You're going to see me post the statements. I'm going to have everything documented. There's nothing that's going to be left to speculation. There's nothing going to be, well, I wonder what his fill was here. Was his stop trigger there? You're going to know everything. Okay, I'm going to tweet. That's why it was the whole purpose of me starting a Twitter account. I'm going to tweet what I see on the chart, and I'm going to tweet my entries, and then you're going to be able to match up what I did with my actual trade statements and the actual time of day when I'm tweeting it. So it's all going to be there for everybody to look at. I've done significant amount of trading, and I've done a lot of really nice runs in several accounts. I'm not providing signals. That's very important that you guys understand it. I am not a CTA. I'm not licensed. I've actually got myself in trouble in 1998 where the CFTC actually did an investigation and subpoenaed everyone that ever sent me an email on America Online, and because no one ever lost any money, yeah, I will be tweeting before the trade. Yeah, I'll be treating, basically, this is what I'm hunting, this is what I'm setting up a trade for, and then you know, the price I'm going to try to get at, but I'm not necessarily saying, okay, I'm buying right now or I'm selling right now. I'm just going to give you the idea of where I'm looking at it, and based on what I'm sharing here and what's on the thread coming and what's already present, you're going to pretty much know what I'm doing, because it's everything that's been shown thus far. I mean, you know what I'm looking for, optimal trade entry. You know if I'm buying, where I'm going to try to buy at between 62 and 79. So yeah, I'm not doing it, guys, for you guys to go out and take $5,000 off a credit card or take $5,000 out of your 401k and try to, you know, try to mimic everything I'm doing, because I'm going to lose money. And I'd hate to have someone send me an email say, look, you know, I've been following your trades and I made, you know, 10 trades in a row. I risked, you know, 8% because I want to, you know, beat ICT to $1 million, and all of a sudden they just got, you know, crushed. I don't want to see that kind of stuff, guys. And again, I'm not trying to do it for people to hold my hand and run with me. Okay, I'm just saying, if you do it, it's at your own risk. I'm not suggesting you follow me that way, but I'm just saying I'm doing it for documentation purposes only. Yeah. All right, well, let's get back to the trade here, guys. Do me a favor, hold all that until we get done, guys, because every time we do that, it pauses the screen sharing when you guys post. Let's get through the presentation and we'll have questions. So if we're buying this low in here, okay, every swing down in price, okay, when price swings down, we're buying that swing. We're looking for the swing high that it's anchored to, okay, because this is going to be the pivot point, okay, or roughly think of it as like a 50% level. We want to hopefully see this high taken out and trade higher, because look at what we did here. Trading above it here, we still haven't gotten to London close. We still have a little bit more time getting into it. Okay, these are 15-minute candles. So now, looking at this, when price breaks through here, we can have, hopefully, by studying this and doing this analysis, in hindsight, guys, there's nothing wrong with you taking your charts, going over the weekend, and saying, okay, I'm going to break my charts up over a 5-minute time frame, and I'm going to put these lines on when time of day is, when was New York open, London close, all these time windows we look at. And I want to look at pivot points and key support resistance levels and previous days highs and lows, weekly highs and lows, monthly highs and lows, yearly highs and lows, quarterly highs and lows. All the levels that's taught in the support resistance video I posted, those are the levels I'm watching. And you'll see that significant price moves unfold at these levels. And they're not levels that you need to guess at. They're predetermined. For instance, on this chart here, if I go up to my tools and I pull up my monthly, weekly, daily, high, low little indicator, all it's going to do is it's going to plot for me all of the levels, okay, and if I need to know what they are, I just put my cursor on it. This is my previous day's low, okay. If I put this over here, this is the previous day's low prior to this day, okay. This yellow line here, this is the previous week's high. So we've broken above the previous week's high right in here. Okay? So all these levels at some point will absolutely have an impact on the marketplace. Now, by understanding these levels and when to anticipate, because that's what really you should be doing. You're not reacting to price. If you're a professional trader, hopefully that's the mindset you're gaining with all of this. You are not trying to react to price. Okay, and unfortunately, authors, teachers, mentors that don't have a real strong concept behind how they trade, or if they have misunderstanding or lack of knowledge on how markets actually do trade and how flows actually move within the marketplace, they can unfortunately do a disservice to you as a developing trader, because you're training your eye to look at an indicator. Generally, that's what most people are doing. They have an indicator on their charts, or several, okay? And if you guys are putting like an RSI, a stochastics, a CCI, and all these other, they're basically measuring the same thing. You only need one momentum indicator. Just pick one you like and stick to it. If you're going to trade an indicator, just have one of them. Don't put 15 of them on your chart, because you only need one. And to me, I'm perplexed by how anybody can discern what they're really going to do if they have multiple indicators, because they're all going to conflict at one point. You're never going to have them all agree. See, as new traders, we're thinking, well, if I have 19 of them on my chart, and when all 19 of them line up, it's a guaranteed trade. I'm going to tell you right now, I'll give you $1 million. It's guaranteed that none of them is going to line up. They're not. They're not going to do it. They're all going to have some kind of deviation. So limit to what you're looking at, okay, if you're going to follow an indicator. I like stochastic. I like MACD for a divergence only. I don't like it for any other purpose, because I look at it in means of determining what other traders are looking for, and that'll give me the ability to trade more leverage based on that pattern when it agrees with price action. I'm teaching you price action. You see no indicators on this chart with the exception of fib levels and support and resistance. There's absolutely no indicators on this chart right now. None. We haven't even brought in the indicator yet. Okay. Price action here tells us we're going long. We're looking for a reaction at this high here. We want to take 70% off here. And it means once we get here, we take first profit in here. That may be, for you, maybe 20%. It may be 10%. It may be whatever. I'm not telling you what it needs to be for you. You need to determine how you want to manage your own trade. All right. But you definitely want to have at least 70% off of here. All right. You can do suggestion here. You can take 20% off here. Take half your position off here. Okay. And then let the other remaining portion run to your target. Well, if you haven't already noticed, these extension levels, this is the 127 extension. This is the 162 extension. All right. What that's done is essentially it's measured the move past this high. This is 127% of the range from this low to this high. 127% of that is this level right here. See how we went to that level, consolidated, made a continuation pattern? Suddenly now all your continuation patterns will make sense, and they work when the smart money or large institutional sponsorship is behind the moves. Suddenly all your technical analysis will have 100% accuracy. Market moves up right to the 162 extension. Okay, this is right here. If you do not take your profits right here, okay, and then tighten your trailing stop loss, for me, I like when I get to the 162, if I'm going to maintain the position, like on a position trade, my stop immediately goes to right below the 127. So for trade management notes and guys that are keeping track of all this stuff, I use this level here if I'm going to maintain. I, right here, used 164.50 to get out. Because if I want to get profit at 162, I want to get out when the market's still moving in that direction. All right? I don't want to try to get the very high. I can call the high in the thread. I can call the high on my tweets and stroke my ego that way. But when it comes to my money, if I'm trading $1.5 million worth of leverage, I don't want to wait for it to get right here, because it might just go right one pip to it, and I may not get my fill on it, and then all of a sudden it gets this. I missed it. I've given up some of the move. I want to get a target where I'm comfortable, where I know it should very easily get to, and if it flirts around, goes past a little bit, even 20, 30 pips, I don't care. I'm not trying to be right. I'm trying to be profitable and trying to maximize the amount of profit that the trade can pay me. All right. The other window that you definitely want to be out of the market by is 1,800 hours. All right, so let's look at that. All right, so here's 1,800 hours. So even if you held on to it past London close here, and you took your profits at 1,800 hours, you still have the lion's share of the trading day. I'm not making this up because we're doing it tonight and there's new people in here. I'm telling you, if everyone that's been involved with this thread, you've seen me mention this before. 1,800 hours, you want to close the trade for that session. All right. All right, we're getting some action while we're talking. That's kind of neat. Why do you think price reacted here? Well, we have traded down. All right, we traded down into this old high here. All right, but we're using a wick. Notice how this is just a wick of the candle. It's not really a body. All right, so you want to train yourself. Look to the left of your chart. Look to the left of your chart when you have just a candle you're pulling a fib from, when it's just a wick like this. Go to the left of your chart, okay, and find the level that this reaction high was keying off of. All right, we may not see it on the 15-minute chart, so you go to a 1-hour chart. And let's grab a, we can use this one down here. Alright, this is why I teach use the bodies of the candles only when you're looking for key support and resistance levels. You can time trade using the wicks of candles, okay, if it has an agreement with optimal trade entry, pivots, and other confluences of events. But still, when you're using the concept of support and resistance and looking for key levels, I want you to take notice of all of the consolidation we had right in here. I'm putting the line right on the bodies of the candles. Okay, I'm trying not to get the wicks. I'm just using the bodies of the candles. The majority of where price was trading at and stopping on the bodies. All right. We had some body action right in here. Now, if we go back down to that 15-minute chart, watch the magic. We have 163.83 suggested as a potential support line. Right in here, price does not trade to it. Does not trade to it, okay? Because we're looking at a chart that shows what? The price you would be selling at. So if we're going to be buying, the spread's got to be factored, and that's what you see here, the difference. In other words, you have to make sure they have that mindset when you're looking for buys. You may not see price come right down to the actual level. It may be a few pips, and basically it's going to be the spread before it gets down to that level. So you'll see it just trade to that point and go up. Let's look at another swing projection. If we use this high in here, remember we were looking at this one here and we looked at here, so we're going to look at each one of them. Here is 200% extension. In other words, we're taking this high down to this low. If we're buying it, we want this high to be taken out. If we see it run up, you can take this level here, times it by 2, add it to this high here, and you'll get this high here. So you got the confluence of let's use this level down here. I'm going to drop this level right on that 200 extension. And now we'll pull that fib up back up to this high here. So we have this level and this level all in here suggesting possible objectives for price to take profits on this move here. Okay. Now mind you, we knew these levels existed, okay, back here based on just this swing here. The premise was we were getting long. Where are we going to get long profits taken out? First profit 20-30 pips, fund your position, move your stop to even. Okay, so even if it comes down and stops you out, you've made something on the trade. Alright. Then you want to take first major portion off at old high you're pulling the fib from, which is right here. So 70% you want to take off right here. If you have these levels here expecting a confluence of reasons to go and get out of the market, okay, that right there, that's huge. That's absolutely phenomenal in terms of reasons to suggest price to top out. Now, does it mean it's going to stop dead on a bang like that and not go any higher? Certainly not. Certainly not. Okay, because we could have very easily traded down and they made one more little ramp up and go 10 more pips, and somebody invariably would have been on a thread if I would have said this was going to be the high. Some schmuck's going to come on there and say, hey, well, look, ICD was wrong because see what happened. It ran up there and went 2 more pips, so he didn't get the high of the day. That's not what I'm looking for. I want to know if I'm making profit from 162.80 and I'm getting out at 164.50. I want to find somebody that's going to complain about that. I'm not trying to be egotistical, but I mean, that's what you should be focusing as a trader. You don't want to be writing the nail down the actually high or low of the day. You want to be able to find the lines portion of the move and hopefully be a participant in it. Notice also, we didn't have really any real opportunity except for a very minor reaction back down to the 164 figure here, and then it boom, shot back up again, going into London close, when traders in London will square their profits and get out and take the trades and square up and move to the sidelines. Well, price trading down here, giving you a reaction. What time of day are we at right now? This is Asia. Okay, Asia. Typically, what will happen in Asia, and I'm kind of like deviating from it, but I'm just going to give you a real-time example. Typically, what will happen is Asia will run to old highs, previous day's highs, or previous day's lows, break it just by a little bit, okay, and have typically an unwillingness to go above it. So we can anticipate the market to probably trade down within this range here, okay, and set up a swing for London close. I'm sorry, London open rather. Obviously, if we trade up significantly here and then find support at this low, this high here, that would really indicate that London open is going to be wild. So that was this was the level we reacted to. Why we would have expected price to trade up to here is because it's the old high here. Okay, so this was Friday's high. So hopefully this has been explained as to why I got in here and why I got out, but what made me expect this to go up. So that's what we're going to look at now. Let's go and zoom out. Okay, we have our key level in here. Let's look at the fiber after we change to a 5-minute chart. Sorry. All right, and we're going to take the fib off. We don't need that for now. So we have price trading down and a fib. Optimal trade entry right here. We're going to look at the same time frame on the fiber. Okay. Here's that same drop down into New York open. All right. Right in here, in these levels, right in here, you're looking for the opportunity to go long. If you're looking at just time of day trading, okay, here is central pivot, here's S1 or support 1. If you're below the central pivot, you are what considered in the bank trading world that's the buy zone. Okay, the central pivot is always referred to as value. Okay, that's your equilibrium price point. Okay, price will generally try to, at some point in the day, try to trade back to the pivot level, the central pivot. Okay, does it always make it back to it? No, but you generally will see price try to pull back to that level. All right. Here's a central pivot here. We were down in the New York open session. Price trades up to, again, the momentum is trying to get back to that fair value. Okay. Does it always mean it's going to get there? Absolutely not. It just means that always try to look for price to try to go back to that central pivot. It's like that elastic band. Okay. Imagine your finger, okay, having a rubber band on it. And if you hold your index finger in front of you and you loop a little rubber band over top of that finger and you let it dangle and you pull straight down, if you let go of that rubber band, it's going to try to snap back up to your finger. Okay, if you pull that rubber band above your finger, okay, and you release the tension, it's going to snap back down to your finger. Kind of think of price, that same elastic band premise, and that's what happens generally. Every day, price will always try at some point to get back to central pivot. The only way it's going to deviate from that is if it's news event driven, and you've seen that Friday. So let's look at. Okay. Guys, can you still see what's going on? I just switched over to a different screen. Can you hear me? Okay. Bear with me. Alright guys, can you see the GFT deal book 360 charts on your screen right now? Can you see that? Is your screen blank? Okay, hang on 1 second. Alright. If you're not ready, let me know now because I'm getting ready to go to full screen. Okay, can you see GFT charting now? Okay, thank you. Alright, we're going to go over one of the main staples to how I'm able to ferret out these really handsome moves. I know some of you guys are like, how's he finding this stuff? But it's basically a concept that I've already given out. It's one of the truest forms of seeing, like an x-ray view of what smart money is actually doing in the marketplace. And you can see really handsome trades unfold using this concept. And what we're going to do is we're going to show how to build it. And I know some of you guys don't use GFT, but this is basically how it works. You can go on Daily FX. I think it's FX Daily or dailyfx.com. For life, I can't remember exactly what it is. I don't use it that much, but I did find that it does give you the capability of making an overlay chart. But I think it's dailyfx.com. If I'm not accurate, it's fxdaily.com. One of the two. You guys know what I'm talking about? Dailyfx.com, is that what it is? Yeah, Daily FX. Okay. If I saw it, yeah, I just needed to see it for whatever reason. I was drawing a blank. All right. Basically, what you'll have is you have a typical price chart. Okay, candlesticks, and really, what you'll want to do is you want to change that to a line chart. All right. And let's use a 1 hour time frame just for a simple fact. It's a lot easier on the eye. Alright, now this is the overall price swings on a 1 hour chart. Now this cool little application is very neat in the way that it will show you significant price highs and lows that are absolutely being accumulated and distributed at. And let's look at now introducing a second market, and we're going to look at the cable, and we're going to draw a chart right on top of that. Okay, so now we have an overlay of the two pairs that I like to watch closely because they're closely correlated. Alright, and I'm just going to scroll through and just pick out a few few moves that this tool is able to ferret out. I'm trying to, it's kind of cumbersome trying to show you this, guys, on my laptop. If I could have my main system, it'd be easy, but I don't use it for internet access, so you have to apologize. I have to apologize for that. Alright, and what we'll do is we're going to zoom in, and we'll use most recent action. Alright, this right here, just looking at that, looks like a mess, I'm sure, to most of you. Alright, but what I want you to look at is, see how we made a high here? This is a reaction high in the market. Alright, when price makes a reaction high and trades down, what you're going to start looking for, if you have a reason to go long, you want to be looking for means of divergence between the two correlated pairs on a line chart basis. Alright, if you, let's draw this on here. Alright, these lows here, comparably, we're going to look at between the two pairs. Alright, the red line is clearly, everybody should know what this one is, it's the fiber. Sorry, I said that wrong. It's the cable and the fiber. Trying to get it where I can show you and not have both the lines getting in the way. Okay, your green line here and your red line here. Red line is fiber, green line is cable. Okay. Notice how at this reaction level here, alright, price trades up and it makes a high and trades down. Alright. Comparable time, same time, because this is exactly when everything's happening between the two pairs. The cable makes the same kind of respectable low here. Alright. See this little, and this is a 1 hour chart. See how this low here, between here, is basically a little bit lower, if not the same. You don't see that happening in the fiber. That's all you need for a reaction in price, and that's indicating there's accumulation going on in the time frame right here, and price moves up. Alright, so now when price trades down, okay, and we'll find the reasons for this going here, because you want to cycle through all your key time frames, daily, 4 hour, 1 hour, 15-minute chart, and 5-minute charts. I'll use a 5-minute chart for the SMT if I'm really gung-ho about a particular move, but generally it's about, usually it's a 15-minute chart generally and higher. So I want you to look at, see how the red line, which is the fiber, when we broke down below this low here, okay, this market was being distributed. In other words, the fiber was being sold off. Look what the cable was doing. It was unable to get below this level here. Okay, so this is showing that the cable was being accumulated. Alright, there was a huge, massive accumulation taking place in this market versus this market. Alright, let's look at a 4 hour. and it should be jumping off at the chart at you right now. Okay, do you see that? This again, we're looking at comparable lows, okay? Because if we have a premise to expect it to go higher, okay, we're going to look for a divergence between the two closely correlated pairs, and we have it here, okay? And then price was unable, see how price on the green line, which is the cable, it was unable to move lower. At the same time, the fiber broke lower lows, okay, and was being distributed. It doesn't mean that they're not going to move in tandem when the significant price move unfolds. It just means that you can ferret out the shift in the major tide. You're going to have a sympathy play with the fiber generally if the cable goes up hard, but you maybe not necessarily always going to be able to determine with standard analysis concepts when this tide's going to shift. And I spend more time looking at this type of premise to my trading and selection on trades than I do on any other thing else. Basically, I spend more time on determining where are the market players positioning themselves. Okay, and this was the move for Friday, and this is the huge, massive accumulation that was taking place in the cable. Everything else took place right here. This is where the optimal trade entry at the time of day, New York Open, at the time when GDP was being released. It was unable to get lower because there was accumulation being taken place. There was not that much accumulation taking place in the fiber, even though it did move up in tandem. It was the precursor was the fact that we had an inability to go lower on the cable. Now, it is not limited to just this one-time event. I'm going to show you on a 4-hour chart some other price swings. And I realize for people that are new to this, it's probably looks very cumbersome, and because I'm trying to show it to you, I'm used to seeing it. I can see it pretty quick and not have to go through all this gymnastics with it. But when you get comfortable with your own charting package or whatever resource you use for pulling it up, whether it be Daily FX and using I think it's NetDania, the free charting they have there, you can create the overlay there. I think I did a video on it. I know I did, but I'm not sure exactly where it is in the thread, but it shows you how to actually build it on NetDania. But here we have price trading up. Okay, price was trading up in this market as well. But look at the divergence between the two in terms of highs. Okay, you're going to see that the market, see the red line here? Okay, this market was going higher while the cable was being distributed. Okay, fiber going up, cable saying I don't think so. So what is this telling us? Okay, it's not, I'm not trying to just dazzle you with the fact that I can pull a divergence out between two correlated pairs. That's not the premise. The premise is, think about it like this: if the fiber and the cable are so closely correlated that they move in tandem, okay, and if smart money, banking institutions, huge traders, that the market making entity that we use to facilitate our trades, in other words, the momentum they provide, because they do such huge positions, okay, it goes without saying, if they're going to sell short the market, okay, and they're going to sell short a particular commodity or a particular stock in an industry group, or if they for Forex, if they're going to short a particular currency pair versus another pair. As we have here, these two pairs are closely correlated. If one of those pairs diverge when they both are moving in tandem up, the one that's failing to go higher, there's a reason for it not going higher, because there's a huge, massive distribution unfolding in that pair. In other words, they're doing such a huge block, okay, or position in that move or in that time frame that the chart is going to reflect it. I mean, you can clearly see that's a huge footprint right there. I mean, that's massive. That's a huge distribution phase right there. It's not going to happen to the very day. It gives you time. I mean, these are days. I mean, and it's not like it's happening in a 5-minute chart. This gets you prepared to look. I need to shift my mindset from going net long to now I'm looking for now short positions. Okay, and when you start looking for these major shifts in tide, you can position yourself for the next significant price move that's going to unfold in the marketplace, where you see these 100, 200, 300 pip moves. I'll give you another one. You've probably already seen it if you've been getting ahead of me. All right, I used the wrong one. Sorry. We'll put that over my in a minute. Okay, we have this reaction low to this reaction low, comparable lows in the other pair, same time. Okay, we had cable breaking down. Now we had a shift. Now the fiber was being accumulated. Okay, fiber was being accumulated. So they're buying fiber. They may be buying the cable, but they're more bullish on the fiber. So that was your timing for the 24th to look for buys. And if you look at this time window right in here, all of your time of day understanding that we've taught with kill zones, optimal trade entry, below the pivot, if it's a buy, major key support resistance levels, the key off for a buy signal, all of a sudden all of your analysis techniques and any bullish divergence on your indicators would absolutely be perfect right in here, because you have a smart money or institutional sponsorship premise behind your trade. Now notice that the cable did go up a little bit, but it's almost lackadaisical compared to the nice move that we see in the fiber. Okay, see how that was a shift in tide, and we went from this sell to accumulation to buy to now look what we have here. We have another major shift in the market tide. Okay, we have lower high, higher high. Okay, and I'm probably confusing you with all these different lines, but let me just get them out of the way. It's faster that way. Okay, market trades higher. Cable's unwilling to make comparable highs. It's saying, no, I don't think so. We're going to go lower. So you look for shorts in this time frame, and then market trades down. Cable was able to go lower, but we really sold off nicely on the fiber. Okay. Let me go back to a cable chart for just a second. Okay, and fiber. Okay. All right, so now that is a huge advantage for us for a swing trader, because we can get our mindset swung to where the most high probable direction the market's going to trade to based on institutional sponsorship. In other words, these divergences only happen when there's a big, massive player in the market, and when they're moving the markets like this, you absolutely can't be staying away. You don't be buying. Okay, don't be buying in this type of condition, because you'll never get ahead doing that. Let's go to a 15-minute chart. I know a lot of you guys like to trade intraday, and the most exciting word that's being tossed about with Forex is scalping. And I really try to turn people off to the whole notion of scalping, but you know, this is one way you can nail down some really good gainers. We have the same premise in the shorter term time frames like this. Okay. Note the time of day, and you'll see that this right here becomes a kill zone, optimal trade entry, vertical. Okay. So hopefully this is kind of like got you interested in the concepts that we'll be introducing later on with more amplification of how we can look for smart money. And if this confuses you, okay, and I'm guaranteeing you there's probably several of you who are saying, okay, I can see it when he draws it, but I don't necessarily think I'd be able to see it if I was looking at it myself. So for those individuals, I'm going to give you this application. All right. Can you see the lower low here versus the higher low here? Okay. This one went lower. This one was unwilling to go lower. Okay. That's accumulation. You're seeing accumulation take place in the marketplace. Okay. This low to these lows. We went lower here. Unwilling to go lower here. Okay. When you see these events happening, when your trade premise or idea unfolds for a buy, this adds a huge amount of probability for your trade to be like this. In other words, you're going to get the tide in your favor. It doesn't necessarily mean you're going to get the exact entry point timing wise. It just gives you the stage that's most likely to unfold for sizable, larger magnitude moves. Okay, and that's what you need as a short-term trader, because you want to have the trades give you at least 2 to 3 times what you're risking to have any real means of longevity in trading. Because let's face it, guys, when you're brand new and you come into this, you don't know much, and you just want to get in there and be in the water splashing around. So if you can get your trade set up where you're risking, 20 pips to make 60 pips, and you don't lose that many times, okay, obviously you're going to do great. But if you have that same risk to reward ratio and you have losses, but you keep your risk to 1% or less, you can still have the ability to stay in the game long enough to hopefully learn from your mistakes and then capitalize on what you did wrong and don't do that again. So for swing trading, I think this concept of looking at lower lows versus correlated pairs, I know a lot of you guys trade yen pairs. Let me just throw this one up because this is one that works real well too. Let's look at the Euro yen and the pound yen. And I'm going to put this in line format. Okay. Let's pull up an hourly to get the reaction levels. Okay. All right, we got lower lows here. Not seen here. What's the tide going to be? Well, it's diverging bullishly. Okay, it's a positive divergence. That means expect the shifts to go up. The tide or the flows will now move higher. When will they stop going up? Well, you wait for a counter move event to unfold. Okay, we have lower here, really unable to see that right in this one, but we did see some fall off in here. Made a lower low here, unable to make it here. Shift's going to move higher, moves up. Okay, we did have, okay, notice this high was almost equal to this one, but we really were significantly lower here. Distribution, market trades off. Go to a 4 hour. You can see the high that we didn't see on the 1 hour. We can see here, higher here, unable here, and then we get that huge drop off. Lower lows here, unable to do it here. Shift's going to be bullish flows. Give me a second. I'm going to go back to how we use the entry based on this premise, but this is basically how you determine where the next market direction is going to be as a swing trader. Okay, lower lows here, higher lows here, so we're going to see a shift in flows, bullish flows up, and then we have a divergence bearishly here, and then it shifts the tide lower, and we look for lower on that pair and was not met with this pair. So we have accumulation, and we've seen recently now just what's unfolded. And even on the daily chart, you can see really huge, massive accumulation and distribution phases in the daily time frame because, well, it's a daily time frame. Okay, lower lows not met with this low here because it's comparable to this low. These lows are comparable to here. Significant accumulation undertaking in on the 30th, and then boom, we took off. That's December time frame back here, guys, in case you're wondering what that is. You can see not making higher highs here, higher highs here. You'll be able to see that on a 4-hour chart. And we had, well, here's another way I like to use it. And I got this idea from Larry Williams' accumulation distribution formula. If you do any reading on Larry Williams, he had a formula that I use also that I'll be releasing. It's not that I'm releasing because it's mine. I'm releasing because I use it. It works the same way this is showing you, like major significant divergences between price to highs and lows. Without an indicator, we're just looking at pure price action. So this low right here, we broke this low here, okay, but comparably we didn't break the low on this pair until here, so we were under some distribution back here. So even though I won't necessarily need to see a high fail, if I see lows breaking out before the other pair, that also just signals to me that, you know, we're under distribution, and there we are. So that is the smart money tool. There is a lot more to it than that, obviously, but when I refer to a SMT divergence, I'm referring to this, and hopefully it was, if not understood completely, at least you got a better understanding of what I'm referring to when I'm referring to it. But the reason why I use these pairs like this, because the dollar is the counterpart to the euro and cable on the pairs that I trade, and because 90% of the volume is traded through the USD pairs, the majors, I just did two fibers. I trade those two pairs because they're closely correlated and it has the most volume in terms of the forex pairs. But you can use the pound yen, you can use euro yen for your S&P divergences if you're a yen trader. Again, I'm not a yen trader, but I have traded it and it does work. So if you limit your trades to these types of setups, here's lower low, no way, didn't see it there, and then took off. Lower here, broke down, unable to do it there. It just gives you like and this is daily. This is not like intraday. This is all daily. It just gives you a really good means of determining where buying pressure is and where selling pressure is, and you can see it unfolding in ahead of time. So without having a premise to a trade, you don't want to look for the SMT. And SMT divergence is a confirmation tool. In other words, if you look for a key support resistance level on a higher time frame and price is trading down to it, for instance, a key support level, the way you have strength added to the trade and you can build more conviction behind your buying that market move is by looking at the SMT. And if you see a accumulation between one of the two pairs that we looked at that are closely correlated, it really gives me the confidence to know that, okay, I'm trading with institutional sponsorship behind it. I don't know who's buying it. I don't care what bank it is, what institution. I don't need to know. We generally hear about it in the news feeds. Oh yeah, so and so went in and did a big block of this. And if you look at your chart, pull up SMT, it's right there. And you just test it. Look at your news events this week. Go over when significant price moves happen and what time it was, and look at the news feeds, and you'll see that after the fact they'll report that XYZ came in and did something, and flows were shifted because of that. And now you have a way of looking at it with an X-ray view and see it unfolding real time. And you don't have to look at it in hindsight and say, man, I wish I would have known, because now you do. Alright guys, I'm going to close this portion of the presentation. We're going to shift back to the chat room for question and answer. I'm not going to use this window that we're using here, okay? We're going to use the Baby Pips chat room. So if you would kindly turn your attention back to Baby Pips, I will still screen share, but I'm going to be using the chat room and Baby Pips. Does it really have only a limitation of 30 people? Well, let's do this. Let's go back. Let's go back to the... wow. Baby Pips has got to have to get with the program here. Give me a second. Let me make this a little bit bigger so I can see what you guys are typing. Okay. Suppose I enter a trade at X position and my maximum loss is 30 pips. Position went to loss of 28 pips and comes back up to X30. Should I close this trade for 3 pips loss? Alright. Cool Caps, if I'm understanding your question accurately, alright, for the sake of explanation, let's assume that you're buying the cable, okay, and you're buying at 164.30, okay, and you want to have a stop of 30 pips. So that means your stop's going to be at 164 even, okay. If price trades down to 164.02, is that what you're asking? Should you close the trade right there or let it stop you out? Is that what you're asking me? Do I still have audio, guys? Can you still read me? Well, I can tell you if you went long at 164.30 and it's trading down to 164.02 and your stop's at 164 even, chances are it's going to trade down to 164 even anyway. It's going to, just static alone is going to tag that because it's the full figure. If you're trading the optimal trade entry, okay, and your stop is 30 pips, generally you're going to probably see if it goes against you 20 pips and it goes below, say, the 79% retracement level. If you're starting to see price trade significantly underneath the 79% retracement level, to me, I'm right there looking to close the trade out. I don't really want to see the stop trade and close me out with a loss. So in other words, if you pull your fib up and you're trading optimal trade entry, this is the reason why I started with this pattern for entry anyway, because it's very universal in terms of where you're getting in at. It's the same price all the time. It's between the 62 and 79% retracement level. If you get in there and you start seeing it trade in your favor and then it pulls back and starts going below the 79% retracement level, chances are it's not a good trade. It's going to probably go all the way down to your stop, and you don't want to be in that. The best trades happen when you get in at that sweet spot, or 62% retracement level, or 79% retracement level in the optimal trade entry, and then price immediately responds and starts to trade in your favor. Okay, and once you get 20, 30 pips, that's why you take profit there and get out. Don't let it hit your stop. If you can save your position, if it's trading below the 79% retracement level, okay, typically your stop's going to be below that low that you pulled your optimal trade entry fib tool on. Your stop's going to be resting about 10 pips below that low. You don't want to see it trade down and retest. Really, for an ideal trade, you don't even want to see it retest that low that you pulled the fib from. So I'm eyeballing that low. If it starts approaching that level and it's below 79% retracement level, I'm closing the position out, and I'll try to go back in again. And if it reacts and gives me an opportunity to get back in, I'll do it, or I'll just wait for the next session. So to answer your question is you really want to be managing your stop loss. Your stop loss is your safety net. It's not there just to get taken out completely. So even though you're risking 30 pips, I'm not saying stay in the trade all the way till 30 pips is taken out. You want to be looking at your optimal trade entry, your fibs. If you start trading down below the 79% retracement level and you're flirting with the low you pulled the fib up from, chances are if it's going to retest that low, it's probably not a good trade. And you'll find that if it does go back down there and you close the trade out and it bounces at that level again, it'll give you a later on in the day, a next trading session or maybe an hour or so, it'll give you another more solid optimal trade entry buy, and then you can get in and you'll see the price move up, because then market structure will have made a higher low, and then everything will be in your favor, and you'll see it extrapolate and move it upside. John, what you were asking about was when I had the two lines, the green line and the red line, you're asking me about that? Okay, they were actually just a line close chart of the fiber, which is Euro USD, and the green was the cable, pound USD. So basically you're looking at a line basis of both pairs overlaid on one another. You're just basically comparing the highs and lows at major swings between the two pairs. Okay, hang on one second. What are some ways to identify a good entry position? Well, how can I answer that without going into another seminar? Well, let's do this. Let's pull up. Let's look at a daily cable. Alright, this is the daily chart on the pound USD or cable. Alright, and this is something that we actually covered last week, and I was asked by Polka how we could use market flow to determine trend direction or trade direction, determine, should we be being a buyer or seller. Now, before I get into this, it's very important to understand that no matter what tool or concept you use, you're never going to be 100% accurate. Okay, you're not going to. So if you're expecting this webinar to, give you some silver lining to your cloud you're in, it ain't gonna do it for you. I'm just going to give you some suggestions that overall, statistically, you're going to be ahead of the game by doing the types of things I'm sharing. Okay, but for nailing down good entry positions is, number one, it starts with where is the higher time frames trying to trade to. All right. Last week we were covering how swing highs and lows in the marketplace are utilized to determine where probable direction is likely to go. Can you see this high right here? This high right here, when price traded up through it on this candle here, that put price into what we call a bullish, okay, or positive market flow. Alright, so what I'm going to do is I'm going to draw a little line, okay, and this is going to be our market flow pivot point. And I'll explain how we use it in a moment, but let me just get it on here first. Alright, this little line in here, okay, when price trades above that high here, now we're a bullish market flow. That means the most recent swing high has been violated. Now the banks and institutions will now have triggered their buy programs. They're going to be looking for long positions, okay? This will maintain a bullish market flow or maintain a buy program until the most recent swing low is violated. On here, the most recent swing low would be here. Okay, so while price traded down here on this candle, these are all daily charts now. These are daily candles rather. They traded down here, traded down here. Now, even though we went back below this swing high, okay, it would have to take this swing low here out to make market flow bearish again. In other words, the flows or sentiment or tide or trend, if you want to use that. I don't like to use the word trend, but the flows, okay, coming into the marketplace are not going to be to the downside until this swing low is taken out. So that's a significant amount of price movement needed to take it back down to going bearish. Okay, it's just a huge rejection. We have a nice hammer here. I know you guys commonly on baby pistols refer to it as pin bars, but to me it's a hammer. And then we have a nice engulfing candle. Took out the high here, so now we have a bullish market flow. What you'll do is you'll maintain the buy program for you as a trader. You want to be looking for buys, okay? Buys, only buys. Even though we have red candle here, red candle here, red candle here, look how much movement we went from the low of this candle. Let's put it right on here. All right, the low was at 160.04, okay? And look at the close, 160.67. Now, would you agree that's a safe assumption that there's a move on there of at least 50 pips from the low? Because somebody was buying in that day. Okay. Now, what about the previous day? Now, mind you, we're looking at down red candles, okay? The low on this day was 160.75, okay? And the close was 161.34. Again, do you see 50 pips in that? From low to close? This candle here. From low of 160.94, okay, the close of 161.52. Again, 50 pips. Okay, I'm not saying shoot for 50 pips. I'm giving you a nice healthy. I mean, if you can tackle 50 pips every single day you're trading, I am not suggesting you guys go out and do this. It's important you understand that, but I'm just showing you potential range, and you're not getting the whole daily range. There's a very ample amount of pips in this days, even though we're going down. Still being a buyer in these days, okay, and I'm telling you, if you go and look at your charts using the concepts that we've shared tonight on these dates, you'll see that there's absolutely, everything we've covered tonight in these days to go along. Now, here's where it gets fun. When we do finally pull back and retrace, and we find the low or retracement back, now market structure has shifted, okay. This swing low here, because once we get this candle here, it's a swing low. Now, I'm sure some of you guys understand that fractals, based on Bill Williams, he requires 2 higher lows and 2, on both sides to, basically classify swing low or fractal low. Well, that's for his tool, okay. But for me as a short-term trader, if I have a low with a higher low on each side, that's a swing low to me. And before we had charting on computers, I used to actually draw rings around these, and I would classify that as my swing highs and swing lows. So as price traded down here, look what formed. A swing high here that was higher than this one, okay? This swing low, because this candle had higher lows on both sides of it, now when it was formed here, this swing low no longer is the trigger point to make things shift on a daily chart bearish. Now, only price would have to need to take out is this low here to make the flows go down. In other words, you're shifting from a buy program to a sell program if this low is taken out. Now, when price starts to trade up, okay, notice what happens. We have a low with a higher low on both sides. As soon as that forms, this day here, man, if you're looking to buy that, you're getting positioned to be in a swing trade, okay? Because now you've got yourself positioned with market flow in your favor. You have a nice rejection. We retraced, okay? Now we have market structure, which is taught in the thread, where you have a swing low, a lower swing low, a higher swing low. So we have a swing low with a lower swing low in the middle. That is a significant low right here we formed. So now if we can get in sync with buying in that market direction, you can catch these really handsome extrapolated moves or range expansion days to the upside, okay? So now, if you're buying on this day, if you bought the low or near the low, it's at 160.67, okay? Let's just use the round number 160.80. Say you bought that, okay, and use the 30 pip stop. You'd still be in a trade, okay? And the high was at 61.73. That's outstanding. That's huge amount of money to be made in something like that. Look what you catch by staying in it, because now you're in position swing wise. Okay, we're not talking about day trading. You're swing trading. If you're in this position here, buying this day, you hold on to it because you're expecting a large range day to unfold on the daily time frame because you're trading the daily chart. You're entering on a lower time frame, but you're trading the daily chart. If you're buying in here, where's the next level of resistance you would anticipate seeing? Well, these highs in here, okay? That you would be looking for these highs to be at least retested, and we've done that since then, okay? So you'd catch this move here, you'd have to ride out some of this, catch this obviously, give some of it back here, then boom, we blew up through here. This day in here, we were talking about market flow. I told everyone in attendance, and some of you are in this webinar present when I was talking about it, so it's not like I'm making stuff up just to sound smart. But this low would have to been taken out for market flow to be taken to buy program to sell program. Okay, we traded down to it, found support, but we didn't violate it. Okay, so market flow is still bullish. So when we traded below the previous day's low here, this was that market report that took everybody by surprise. Okay, that shouldn't have, because if you check your calendar, we had a market event coming into play with the GDP number. Everything got in sync. This same level here, look what happened. Support at old resistance, and then took off. Okay, even on the daily chart, we're getting a rough approximation of that same price point, 162.59. Remember, we were on the smaller time frame, 162.62. That's your reason why. That's a key level on your daily chart. Move down to a lower time frame. Let's do that. Let's draw the chart up on the daily. I'm just trying to make it straight, guys. And for whatever reason, it's fighting me. Alright, the line's there. Now let's draw down to a 1 hour chart. And there's the low. So I drew the line on the daily time frame, and drilling down to a lower time frame, you see where it actually reacts to it. Okay, so that's why I'm trying to tell you in the thread. The way you nail down good entry positions is based on the higher time frame directional basis, and where are flows trying to get to. Where's price trying to trade to on that time frame? Because that's where the banks and institutions are trading, and not on 5-minute charts. Okay. Does that answer your question on how? I know it's probably not a definitive response or a comprehensive response to your question, Nick, but that hopefully will give you something to chew on and look at for this week, and we'll build on that as we develop the thread. All right, for SMT, what time frame you suggest to watch? FX280. Like I said earlier, you want to start obviously with your daily time frame. Note market flow, market structure, and see if you can see any SMT divergences forming to suggest a distribution phase or accumulation phase unfolding. And then work your way down from daily to 4 hour, 1 hour, 15-minute. And honestly, if you're really going to look at SMT for 5-minute, you should already have a premise in mind based on directional bias. Are you trading in the direction of the trend based on the London Open, whether the high was formed or low formed, and you're trading in that direction, and using the SMTs to confirm what should already be on your chart based on pivots, support resistance, and optimal trade entry. But if you're asking for a go-to catch-all time frame, me personally, I like the 1 hour. It doesn't mean you're not going to have divergences you're going to find on lower or higher time frames. It just means that I like to refer to the 1 hour more frequently than any other, because it's dynamic. It's changing a lot more frequently. Yeah, I saw your question about the carry trade, and I personally I don't concern myself with carry trades. I don't try to keep up with which rate's the best right now and all that. I just simply trade price, and I'm content with what I earn there. I don't want to be concerned about whether the market's in a carry trade or not. Wally, when you're looking for accumulation and distribution, basically you're just looking at closely correlated pairs, okay? And because the pound USD and Euro USD pairs are so closely correlated with one another, I use those two to do all of my FX trading. I don't trade anything outside of that except for the Euro pound maybe pair, but you can determine accumulation and distribution in well, I'll give you an idea, and this will kind of help build it. If you Does anybody in here trade stocks? Any stock traders? I'm not talking stock investors. I mean, are you active stock trader? No stock traders. Okay, I thought I'd get at least one or two of you guys to be a stock trader, but you can see the same concept, okay? And this is how I used to trade stock options. Every 3 to 4 months, I would take positions in the stock market based on what I'm about to show you right now. In 2 minutes or less, I'm going to show you how to be an avid, professional, high-grade stock trader. Ready? If you plot a Dow Jones Industrial, NASDAQ Comp, and S&P 500 on a daily chart, okay? When one of those averages fails to make a lower low, you have what is referred to a major market divergence, okay? Then all you do is look at all of the industry groups, okay, that have failed to make a lower low. Within those industry groups, you're going to find stocks that make a higher low. In other words, they're going to fail to make lower lows. Those stocks, you look at the valuation of the options. If they're undervalued, you buy call options on those, and you hold it for 3 to 4 weeks, and you take it. If you get a double or a triple, you cash out and you're done. If you're a stock trader, you trade just like I just showed you here, using swings, project the swings from the high that you pulled a fib down from, like here. Say this is a stock. You swing down here, you buy in here, you're going to use the same concept we used to take profits. You're basically, you can see the institutional sponsorship in everything that's traded, but you have to have a basis or a benchmark to measure it from. In other words, I'm basing the pound and fiber trades on the USD, the dollar. Okay. If you're a yen trader and you use the pound yen, euro yen, okay, you're trading with the benchmark of the yen, and you're using the correlation between the two pairs because they move generally in tandem. So outside of those 4 pairs, there is ways to trade SMT, but I was going to share this on the thread, but so many people have had such a hang up with just this this approach to doing it, and to me, I think it's kind of easy. But for some reason, a lot of people can't grasp it. And there's ways of using inverted correlated pairs. Okay, in other words, pairs that move mirror image of certain pairs, but you can still get SMT divergence with that. Kind of like how the euro is counter to USD. So if the dollar's going lower low, if the fiber, okay, makes a failed higher high, that's an SMT divergence. Yeah, the NASDAQ the composite index. This is an exercise toaster. If you just look at a whole, take a look at your the last year in the stock market, okay, Every turning point that took place in the market happens every 3 to 4 months. Look at the highs between those three averages. One of them every single time diverges. When that failure swing happens, that tips you off to, okay, if you're a buyer of stocks and you've been riding a move up, if you see one of those averages or indexes diverge bearishly, it's time for you to take profits or tighten up your stop very, very tight. And in that way, if it does take you out, you're not going to ride that dip down. Right, and counter trend. If you look at all the times when it was going up, right before it did, compare the lows on the daily chart on these averages, and you're going to see one of them fail to make a lower low, and all of a sudden the major market tide shifts up. That in itself tips you off, and you can use that. And I'm not going to teach tonight because I'm going to be going forever, but you can use that insight with your forex trades too. But that's a whole nother seminar altogether. But there is a way to track smart money, guys, and it's a very generic concept. You don't need to have indicators. You don't need to have bells and whistles and EAs and all these robots and stuff. Robots aren't going to get you trades like Friday. Okay, they're going to get you scalps and little nitpicks here and there. But price action trading and understanding where flows are going and where stops are, and swing projections and all that, and time of day, and all these premises added together dovetail nicely into a professional approach that we're still working on. We're still unveiling portions of it as we go. But hopefully tonight was one more piece of the puzzle, and I'm really going to have to close it here. So unless we have something really really easy to talk about, I'm going to close the audio portion because I've talked myself almost hoarse. I'm not saying I'm not going to stick around for text answers, but I got to be able to close it for the audio. Is that okay with you guys? You're very, very welcome. I enjoy this. Did anybody learn anything? I know it's fun to look at, but did you get anything from it? Okay. Guys, what did we talk about earlier about the Asian session? What's the repeating theme that takes place in Asia? It'll trade up to previous day's high, break it, and then what will happen generally? Trades back down into the range, and you saw it real time. That's how you trade Asian. So basically, you guys got the how to trade Asian session as a bonus. Yep. And so far, we had price trade from 164.74 to 164.47. That's about a classic Asian range trade right there. If you look, daily fiber was to flow up or down. Are we talking about the same, basically same time comparable to what we discussed with the cable? Here's Friday's candle. Traded below this low here. Okay. Now, if you're using the fractal indicator, I'm not sure if you're showing it on MT4. Let me switch over real quick to MT4 and see if it gives me. Can you see the MT4 chart? Okay, so you didn't have a swing low or fractal until Friday. So until this low was taken out, flows were up. Do you get that? Alright, just for confusion's sake, I'm making sure I'm asking and getting the same response I'm aiming for. Give me a number 5 if you're not seeing MT4. Okay, and MT, that's even better. Hold on 1 second. Got it now? You should see MT4 now. Okay. Here's Friday. And we didn't get a fractal low until Friday. So until this low here is violated, market flow is bullish. You see that? As soon as you get a bullish market flow, okay, bullish market flow, the only thing you're going to be worrying about is where is the swing low. In other words, bullish market flow only changes when a swing low or fractal low is violated to the downside. And it remains bullish until that happens. As we make higher swing lows, like we move from here to now here, until we make a new swing low that may be higher than this one, this is the pivot point that changes bullish market flow on a daily time frame to lower bearish market flow. And you just move that point, because right now even though we made higher swing highs in here, that doesn't mean anything because we already got bullish market flow based on this broken swing high here. And now this is the swing low we watch. Okay, and I'm gonna have to move into the house because my battery on this laptop I'm using is getting ready to die. I've got a lot of resources going right now, draining it. And with the bullish market flow, we can see how we had the Asian range today, well this evening rather, trade. Okay. Here's the gap. We traded down, filled the gap, and for the cable, we had price trade down, old high, resistance, now becomes support, trades up to retest the previous day's high, flirt just above it is a couple pips, and you see it happen right here. Let's put it right on the high, and you can see a little bit of motion above that high and then slammed it right back down into the range. Surge, if it's any consolation, when we were discussing it for Polka's purposes last week, when we were doing like a one-on-one session, I was going over market flow. If you look at the fiber, and let's pull up real quick before my battery's dead. You can see how we have bullish market flow here because this high Alright guys, we are going to cover a few topics tonight. You should see MT4 now. Okay, here's Friday, and we didn't get a fractal low until Friday. So until this low here is violated, market flow is bullish. You see that? As soon as you get a bullish market flow, okay, bullish market flow, the only thing you're going to be worrying about is where is the swing low. In other words, bullish market flow only changes when a swing low or fractal low is violated to the downside, and it remains bullish until that happens. As we make higher swing lows, like we move from here to now here, until we make a new swing low that may be higher than this one, this is the pivot point that changes bullish market flow on a daily time frame to lower bearish market flow. And you just move that point because right now even though we made higher swing highs in here, that doesn't mean anything because we already got bullish market flow based on this broken swing high here. And now this is the swing low we watch. Okay. And I'm gonna have to move into the house because my battery on this laptop I'm using is getting ready to die. I've got a lot of resources going right now, draining it. And with the bullish market flow, we can see how we had the Asian range today, well this evening rather, trade. Okay. Here's the gap. We traded down, filled the gap, and for the cable, we had price trade down, old high, resistance, now becomes support, trades up to retest the previous day's high, flirt just above it is a couple pips, and you see it happen right here. Let's put it right on the high, and you can see a little bit of motion above that high and then slammed it right back down into the range. Surge, if it's any consolation, when we were discussing it for Polka's purposes last week, when we were doing like a one-on-one session, I was going over market flow. If you look at the fiber, and let's pull up real quick before my battery's dead. You can see how we have bullish market flow here because this high